My experience with Alpha so far has been nothing short of exemplary.
The word that would best describe them, I think, would be trustworthy.
They're just a fantastic group of people.
We have a fantastic team in Alpha Wealth. We're all fully qualified individuals with over 60 years of combined experience between us.
I've spoken to so many different people that they feel like they've just like an extra cousin I've never met before, and they're always there with a kind of a helping hand to do whatever I need.
They have a very professional approach, and you feel like you're getting advice that you can trust and rely on.
They're a company that I would definitely recommend to friends and family. Nick and the team are there at the end of a phone or at the end of an email, and they'll always come back to you.
Alpha Wealth provide a full range service to our clients' needs, just to make sure that you're doing the right things for you and getting the most from your own money, getting it working harder for you and ensuring that your family are protected.
Hello, everybody. We'll kick off there. My own name is David Looney. I work as a financial planner with Alpha Wealth. Thanks a million for everyone who's after coming on. We had quite a few registered for, I suppose, today's webinar and the one this evening as well. I think there was nearly 300 registered between the both. So thank you very much. And thanks to everybody who's after sending in a question as well. We will allow some time at the end to get to the questions. If anyone didn't have time to send in a question, but they do want one answered, I suppose under any areas of kind of personal finance, feel free to pop it into the Q&A box and we'll try to get to it at the end. So just to give people a quick introduction to who Alpha Wealth are, for those of you who might not be aware, we basically run a impartial financial services company based out of Little Island in Cork. And we basically provide financial advice to individuals and families like yourselves in pretty much all areas of personal finance. So things like savings and investments, retirement planning and pensions, protection insurance, mortgages, tax, and pretty much everything else within that space. And it's really just about helping people, make better decisions with their money and make sure that their future is looked after. Just some key points about Alpha Wealth. We are a central bank regulated company. We've 8 qualified advisors in Alpha Wealth who have over 60 years of experience between us. We currently have over 3,000 clients from all around Ireland who have over 120 million euro of assets under management with us. And I think a really important thing for us and you guys is that we are impartial advisors, which means we're not a tied agent for any of the providers in the Irish market. So it's about finding, I suppose, the best performing, the most appropriate, the most cost-effective solutions for our clients. So today's, I suppose, webinar really is just going to be some key steps on how you can hopefully improve your financial situation and look after your future. The key takeaways really are, firstly, establishing your financial goals. Then we're going to be talking about how we can effectively plan for meeting those short-term, medium-term and long-term goals, and that we're using the right vehicles to meet our objectives. We're going to be talking quite a lot about how we can reduce how much tax we're paying as well, which is quite timely with all the, I suppose, changes in the budget under BIK rules, and as we're coming up to tax deadlines and year ends. We'll be focusing a bit as well on how you can save money, which I think would be really handy for people as well with cost of living and inflation, just some things that they can, I suppose, free up some expenditure in. And finally, we'll just be giving some information on a exclusive discount that we will be giving to everybody who is on this webinar today regarding booking a full financial planning consultation with us. And as I mentioned, we'll follow up with a Q&A session then as well. Okay. So look, we'll crack into things. So when I meet a client for the first time, I always try to get to the bottom of, why they're talking to us or what they're trying to achieve. And I'll get many different answers, things like becoming debt free, living comfortably month to month, being able to buy a property in, however many years time, building up a nest egg or an emergency fund or a portfolio, savings for children's education, something we spend quite a lot of time speaking to people about, in addition to, saving so they can retire comfortably at a certain age, or reaching this ultimate goal of financial independence, and making sure that your family is looked after, and reducing the tax. And it might even be a combination of all the above. And I'm sure people on the call can resonate with at least a few of these. And the thing I stress to my clients is, regardless of what your financial objectives are, it's so important to have a roadmap in place on how you're going to achieve them, which is essentially a financial plan. There are certain things that come up in our life that we know we have to plan for. If we have kids, we know they're more than likely going to go to college. We know college is expensive. So the advice is to put plans in place early to make things a bit easier. And I suppose in Alpha Well, what we're trying to do essentially is help you guys getting the balance right when it comes to managing your money and proportioning the right amount to needs, wants, and saving and investing for your future. So after we've established financial goals, it's about dividing them up into what are short-term, medium-term, and long-term. So short-term really is any amount of money that you might need in the next 0 to 3 years. Medium-term is 3 to 10 years. And then long-term could be anywhere from 10 to 20 years or more. So usually, I suppose, you know, as I said earlier, maybe working towards achieving this goal of financial independence, which basically means that you have the option to maybe give up work and not need to work anymore. And I suppose it's so important that we're finding the right balance between all three of these and making sure that we're funding the appropriate vehicles to meet our objectives under each of these banners. An example of that is, you know, for example, if you're saving for a holiday next year in, let's say, a Revolut savings account, you're not necessarily going to be using that as an account for saving for your children's education in 18 years or saving for your retirement in 30 years time, because it's not suitable. So I suppose our role is to make sure that you have the right pots of money allocated to each goal over, you know, various different timeframes. Short term, as I said, is anything from kind of 1 to 3 years, and that could be, you know, building up an emergency fund, which is really the kind of bedrock of any financial plan. That's usually the step one that you need to make sure is taken care of. Ideally, a good rule of thumb is to have maybe 3 to 6 months of salary in an emergency fund, but it is client dependent. Obviously, somebody who is self-employed will need a bit more of an emergency fund than somebody who's, say, a public sector worker or somebody who's working in a multinational that has quite good sick pay benefits. But I would say at least have maybe a buffer of €2,000 set aside. And then it's about identifying other short-term goals. That could be, you know, a holiday deposit, a wedding, etc. And the ideal place to keep, I suppose, any amount of your savings to meet your short-term goals is, unfortunately, at the moment, a deposit account, and ideally one that's not easy to get your hands on. So something like a credit union account or a post office account where, yes, you're not going to get any interest on your savings at the moment, and inflation is going to erode the value. But given that you might need this money in a short period of time, you need somewhere where it's safe and it's accessible. Then we move on to medium-term goals. So, you know, planning, building up a nest egg or a portfolio, or as I said, something we speak to a lot of people about is planning for their children's education costs. This portion of your money ideally needs to be invested, okay, because it's over a longer time frame, and inflation is much more devastating over that longer period of time frame. So as I mentioned, we need to appreciate that the banks, credit unions, and post offices at the moment are offering 0% interest on our savings. So they're really not suitable places for anything other than short-term savings. So 1 to 3 years. Anything beyond that needs to be getting invested and earning interest to make sure that it's growing for us, working for us, and keeping pace with inflation. So if, for instance, you want to accumulate a sum of €30,000 over a 4-year period, even earning a very modest interest rate after tax of, say, 3.5% per year, you can achieve that by saving €570 per month or €400 per month with an €8,000 lump sum. Now, if you're not earning any interest, you'd actually need to save the sum of €625. So it just goes to show that it's so important to make sure that your medium to longer term savings are in places that have the ability to work for you and grow. Just some other examples of how you can accumulate €30,000. If you're saving €150 per month, it would take 13 years. 250 a month, it could take 8 years. 300 per month, 7 years, or 400 per month, 5.6 years. So where can we save to earn interest? Because as I already mentioned, we're not going to get any interest in the bank, credit union, or post office. So I think the go-to for most people in Ireland is to maybe set up a regular savings investment plan with one of the life assurance companies in Ireland. Alpha Wealth deals with all of them, and the one we see as being the best in Ireland is offered through Zurich. It's called the Easy Access Savings Plan. It's the one I use for my own savings, and it's the one I use for the majority of my clients. It allows you to save basically from as little as €100 per month, or put a lump sum into it, or both. So it's, you know, very accessible. It is very, very flexible in that it allows you the ability to increase, decrease, stop, or restart your savings at any stage. and the term is completely open-ended, so you can access your money at any stage. Now, where it differs to a normal savings account is that it allows you to get exposure to some of Zurich's managed savings funds that have really good long-term track records of delivering positive returns for investors over the long term. And they have many different funds which are categorized on a risk and reward scale that you can, I suppose, see over here on the bottom right-hand side. So it's about making sure that you are taking the right level of risk and reward relative to your goals and the time frame that you have in mind. As a good rule of thumb, the further away your financial goal is or your investment horizon is, you'll be encouraged to take a bit more risk and reward, because markets generally move upwards over time, but they can be quite volatile over short periods. So the longer time frame you have, you can afford to take that volatility. So this type of plan is ideal for saving for medium to long-term financial goals, such as saving up money for children's education. Kids typically start college at 18. So what I would advise parents to do there is put away the child benefit of €140 per month into a plan like this, which will give it the ability to grow and keep up with rises in education costs over that period of time. So for something like that, you might look at going middle of the road in terms of risk and reward. So something like a moderate risk fund that will aim to achieve returns in the region of about 5 to 10% per year. But if things are volatile, it can also lose between 5 and 10% per year. Now, what I have to stress for people is that over a very long period of time, we will have a lot more good years and bad years in markets. So it's about, making sure that we're positioned correctly and keeping that long-term view in mind. Just to give you, I suppose, a further example of that, a risk level 4 fund at the moment would be down maybe about 10% over the last year, just because markets haven't been very favorable this year. But if you were in a risk level 4 fund over the past 5 years, you would still be up somewhere between 20 to 30%. So it's about keeping that long-term view in mind. Now, the key thing when starting one of these plans is you need to make sure that you're not overpaying for any charges on them. And we would see ourselves as being an extremely low-cost broker. So we make sure that we give everyone 101% on allocation on their savings to these plans to basically reimburse you for the 1% government levy, which means that you're getting all of your money invested even after the levy is taken. And we would reduce the annual management charges as well. Moving on to the longer term stuff then, which is in most people's mind, retirement planning. And, it's about first thinking about what amount of a fund do I ideally need when I want to retire to replace a sufficient level of my income, and planning towards that. Now, an advisable retirement pot will absolutely differ depending on the individual. So it is on a case-by-case basis. I do want to stress that, but I find that the sweet spot for our average client today is somewhere between 600 to 800,000. Now, that might seem like a little amount to some people, and it might seem like a very sizable amount to other people. But what you need to appreciate is that statistically, a lot of us are spending anywhere between 20 to 30 years of our life in retirement. So it needs to last you potentially for a third of your life cycle. So it is important to build up, a sizable pot to cater for what is going to be a very long time frame. But the reason we use these figures is that if you, for instance, have a pension pot at retirement of 600,000, you get to take 25% of that as a tax-free lump sum, which is 150 grand. And you're then left with €450,000 in the pot, which you're going to draw down an annual income from. A typical drawdown rate would be about 5% per year, which is going to give you annual income of about €22,500 per year. The state pension then will kick in from 66, which is currently provides about €13,000 per year. And between the two of those, it'll bring you up to an annual income of about €36,000 per year, which is currently just under the top rate tax threshold. So it allows you to earn all of your retirement income at only 20% income tax. If you are a couple, you can actually earn up to €36,000 tax free between the two of you. And remember that the lump sum can also be used to draw down further income from to supplement that. If you have a pension pot of 800,000, it actually allows you to get the maximum amount of tax-free cash from a pension. So you can take 25% of your fund subject to a maximum of 200,000 tax-free. So a quarter of 800 grand is 200 grand. So that pot allows you to get the maximum amount of tax-free benefit from your pension pot. Sums like that can be used, of course, to clear any existing debt, set yourself up, maintain a rainy day fund, and maybe put some aside for your family. and then you're going to have 600,000 left in your pot, which would give you income of 36 grand a year, exclusive of the state pension, of course. So that's usually, you know, an income that I would think is, I suppose, enough to provide people with a comfortable enough life in retirement at a time where loans are going to be paid off, mortgages are going to be paid off, and kids are probably going to be no longer financially dependent. So arguably life might be a bit cheaper. Now, pensions in Ireland get a bit of a bad rap, and the industry tends to overcomplicate them, but all they really are is just a long-term savings plan. But because of all the tax benefits associated with them, they are the most effective way of saving money long-term and reducing the tax that you pay. So for every €100 that you put to your pension as a top-rate taxpayer, it will actually only cost you €60 net of the tax relief, and each of those €100 goes tax-free until your retirement. If you're in a company matching pension scheme, you could potentially pay in 100, the company matches by 100, and your 100 only costs you €60 net of the relief. So you're getting €200 to your pension for a net cost of just €60, which is a very, very powerful investment. Now, revenue gives us quite generous limits on how much we can put into pensions, which is shown on the table down here at the bottom. So for those who are under 30, they can put 15% of their earnings into a pension, and that gradually increases to 40% of earnings for those who are 60 and over. What I would encourage everyone to do, regardless of how far away you are from your expected retirement, is to do a quick health check on your pensions. So we look at 4 things here. We look at what the current values of your pensions are. We look at what level of contributions are going into them between yourselves and maybe your employer. Very important to make sure where those funds are invested, how they're performing, are they appropriate, and also what management fees you're paying. And most importantly, what level of income is your current pension pot expected to give you in retirement? It's really important to find out what that figure is as early on as is possible, because if there is a deficit, at least you'll give yourself enough time to put a plan in place to make up the difference, rather than, you know, ignoring it until a couple of years of retirement and then finding out that you're way off where you need to be and you don't have enough time to make up the lost ground. This slide is a bit wordy, so just please bear with me, but it basically just kind of takes you through what can be achieved by putting away a small amount on a regular basis early on. So this is just taking the case of a 30-year-old earning €50,000 a year and deciding to put 15% of their gross earnings to a pension pot until age 65. Now remember, this is 15% of their gross earnings, and that could be coming from both yourself and the employer, so much more manageable than a lot of people might think. This projection, assuming that those contributions are going to increase by 2% per year and we're going to achieve an average fund growth rate of 6% per year, which is very achievable. If anyone isn't getting an average growth rate of 6% per year, you need to look into your pension. So essentially what that would look like is the person's take-home pay before the pension contribution would be about 37,222, or after the pension contributions, 32,723. So they're basically saving 4.5 grand of their take-home pay per year, but they're getting 7,500 hitting their pension account, which is growing tax-free. And in the process, they're saving 3 grand a year in income tax rather than it being lost to revenue. And what that's going to produce is a pension pot of about 929,000 by age 65. Remember, we get 200,000 of that as a tax-free lump sum at age 65. Now you'll notice I have in today's terms and brackets, which is basically, you know, discounting that figure to allow for inflation. The remaining 729,000 in the pot then can be drawn as regular income at a much lower tax rate. Assuming we take a drawdown of 5% per year, that's going to give us an annual income in retirement of 36.5 grand a year, or 18,229 in today's terms when we discount that for inflation. We have the state pension kicking in from 66 then, which is €13,000 in today's terms. So this person is coming out with €31,229 in today's terms, which is replacing 62.5% of their pre-retirement income with pension income, just by allocating 15% of their income to a pension now. And remember, they have left with 200,000 as tax-free cash in their bank account, which can be drawn down further to supplement their income. So this person can actually replace probably over 70% of their pre-retirement income with pension income, just by putting 15% of their gross earnings to a pension now on a regular basis and starting early on. Just to show you guys, I suppose, what can be achieved from my own perspective, this is my own pension projection. I'm 30 and I want to be in a place where I have the option to maybe scale back work or give up work somewhere between 55 and 60. And I might not decide to do that, but it's about having the option and the independence to make those decisions, okay? So that's giving me a 25-year time frame to work up to my financial goal. Now, just so people know, I don't see myself as being incredibly wealthy. You know, I am paying a mortgage, like I'm sure most of you are. I'm paying for, I suppose, saving for a wedding at the moment as well. And I am trying to do up a house, so I'm hemorrhaging money at the moment, but I still want to make sure that there's enough going into my pension pot to reach my financial goals. So what's going into my pension pot at the moment is €258 from the company per month, plus €700 for myself. So there's €958 a month going into my pension pot. But remember, it's only costing me €420 per month after tax relief. So I'm getting more than a 100% return here, even before the money is even invested. And that's why it's so hard to turn down. So based on an average fund growth rate of 6% per year and increasing my contributions by an average of 2% per year, I should be on track for a pension pot of about 834,000 when I reach 55. I get to take my 200,000 as a tax-free lump sum, and then the remainder is going to give me income of close enough to 32 grand a year. It does, of course, have to be discounted with inflation. I'll have the state pension kicking in at 66. So I'll be coming out with somewhere in the region of maybe 32.5 grand a year in retirement by, you know, keeping these contributions in place. And I have my 200,000 tax-free, which can be used to supplement the income further. So look, it just gives you a real life scenario of how people can actually achieve financial independence at quite an early age by putting enough into their pensions and making sure that it's going into the right funds and you're planning effectively. So how are you going to fund all this? It is really important from our perspective that people are saving a minimum of 10% of their earnings. Now, whether that 10% is going into savings, investment, pension, or, you know, either or, ideally it should be kind of split between everything. But I think the people that are saving somewhere from 10 to 20% of their overall earnings are in a really good place. Now, sometimes that's not easy to do, but ways we can, I suppose, help in managing that is to budget and reviewing some of our main financial outgoings as to reduce the cost and free up more disposable income. And obviously Alpha Wealth can help on both of those fronts. I would encourage people to do a monthly budget plan regardless of their income levels, and we have a really good budget calculator on our website, which you can find on www.alphawealth.ie. And basically that'll help you to track your monthly income and outgoings and identify savings opportunities. So how you're going to think of that is look, let's say you are an X, and what you're going to do is try to map out how you can spend 90% of what you earn by allocating 10% to savings first. So it's really important to make sure that your savings is coming out of your account first to meet your financial goals, and you're trying to live on what's left. What you can also do to help in that process is to review your main outgoings, which obviously we can help with. So mortgage is obviously getting a lot of press at the moment, given that interest rates are rising rapidly. So anyone who is on a tracker rate, a variable rate, or a fixed rate that's due to mature in the next 3 years, I think you need to be reviewing your mortgage to be protecting yourselves from any future rising in interest rates over the next couple of years. Because what you don't want is your repayments increasing substantially all of a sudden, which is going to, you know, reduce your capacity elsewhere. You have like mortgage protection policies then, which, you know, the cost of these policies has really come down over the last couple of years. So we're finding that we can save people quite a bit by reviewing those things like house insurance and car insurance, loans as well, trying to, you know, plan ahead rather than taking out a loan, because they can eat up a lot of your disposable income. Or if people have a loan, it's about, look, you know, shopping around and making sure that you're getting the lowest interest rate there. Health insurance is something that a lot of people overpay for as well. And what I would say there is just to make use of any online offers, such as, you know, 10% discounts for purchasing plans online, or maybe kids offers, whereby if you pay for one child, all the rest of your children will go free. And we can look at this for you as part of a full financial review, just to make sure that you're getting the most, I suppose, value on any of your financial plans or your main outgoings. So between looking at all of these things, you can save quite a bit. I'm just going to talk a bit now on some other ways to reduce your tax. We already spoke about pensions being a great way to reduce your tax, but there are some other things we can do as well. The first thing I'm going to talk about is a scheme called the Employment Incentive Investment Scheme, or EIS for short. What it is basically is a revenue-backed scheme which allows Irish individuals to invest sums of money with qualifying Irish companies, typically over a 4 to 5 year period. And any amount of money that you invest with those companies, revenue will give you a 40% tax break on your investment amount as a top rate taxpayer. And you also get a return from the company for the use of your money over that 4 to 5 year period. The minimum investment per company is usually about €5,000, and there are hundreds of companies every year that will use this scheme as a way to raise capital. And for taxpayers like ourselves, it represents a really good opportunity to reduce their tax alongside a pension. So for instance, if you put €5,000 now into an EIS company, revenue will be returning you €2,000 of that just in a couple of months' time. So the net cost of the 5,000 investment would just be €3,000. There's two companies that we are, I suppose, are two options that we're suggesting at the moment under the EIS scheme. Now, there are a lot of early stage startup companies in EIS, which are, I suppose, a lot more high risk, but there's some very established options as well. And one of them is Blacks of Kinsale, which is a beer and spirits company established in 2013. The company is presently valued at about €15 million. Their revenues from last year were about 2.1 million, on track to be 3 million this year. And they are a phenomenal company. They've got quite a lot of industry awards for their spirits and craft beers. And I believe they are in a very supportive market, because Irish whiskey is currently the fastest growing spirit worldwide, and the craft beer market has exploded recently. What they're using the funds for is to make a new brewery and distillery down in a site in Kinsale. I believe it's going to be the first multi-distillery and brewery in the country. And what they're giving is a 28% capped return over that 5 year period, in addition to the 40% tax relief. The other option is through a company called BVP, who actually run an EIS fund. And what they have at the moment is a renewable energy EIS fund. So rather than you investing with a particular company, you would be investing in a fund, and BVP would then be deploying that capital to EIS companies that meet their criteria and due diligence. So on an example of €10,000 invested in EIS this year, so 2022, what that would look like is next year, when you do your tax return at the start of the year and include the EIS investment, revenue will issue you with a 40% tax rebate. So $4,000 coming back to you in just a couple of months' time, which will make the net cost of the investment just €6,000. Then in year 2026, which is the 5th year of the scheme, all going well, you'll get your €10,000 returned, plus the 28% return from the company, which is 12,800 coming back to you. So if you think about that, you made an investment which had a net cost of just €6,000, and you're getting 12,800 returned in 5 years' time, all going well, which is more than 100% return. So alongside a pension, it's I suppose, a really valuable way to significantly reduce how much tax you pay. But of course, it is really important to pick solid companies, and that is Alpha Wealth's role here, and that we look around at some of the companies that are raising EIS funds each year and try to identify the strongest companies in that space for our clients. Some of the other ways, more kind of on a smaller sense, that you can reduce your taxes, things like remote working, claiming back for remote working expenses. Now, this can be done automatically through your employer, whereby they will give you a $320 a day credit, or you can arrange yourself by claiming back 30% on the total costs of electricity, heating and internet costs over that year, which could be quite a lot of money coming back to people, and given how expensive some of these things have got. I already spoke about pensions, but just because we're coming up to the tax deadline, I just wanted to mention an opportunity that people have, which is to make a lump sum contribution to their pension from personal money, so monies that you have in your bank account, and electing to backdate that to last year. So if you have, say, 10,000 euro in your savings, which you don't need, you can actually transfer that to your pension before the 31st of October or mid-November if you're doing your return online. And you basically include that in a 2021 tax return. And within a few days, revenue will kick you 4,000 euro back on that 10,000 euro pension contribution, which would make the net cost of it just 6,000 euro. That's the case for a top rate taxpayer. Of course, a standard rate taxpayer would get 20% relief, so they'd get 2,000 coming back to them. And the thing about that is that the full 10,000 euro would arrive into your pension, which grows tax-free to your retirement, and you get 4,000 back into your bank account. So a great way of reducing your tax from last year and generating a good return on your money. Then you have things like, I suppose, and I appreciate this won't be suitable for everyone, but rent a room relief, which allows you to rent out a room in your house and claim up to 14,000 euro a year in tax-free income. And you don't even have to own the property to do that. You can actually sublet it as well under those rules. Something that might impact a lot of people on this call is changes to BIK. So for anyone who has company cars, the situation is going to be very, very different from next year, because the calculation of BIK will be based on a combination of mileage and CO2 emissions rather than just mileage. So if you take a car which has an original market value of 37 grand, that was doing 25,000 business kilometers a year and emitting 150 grams of CO2 emissions per kilometer, as things stand, that would have a BIK of about 8,880 euro. Under the new regime next year, the exact same car will actually give rise to BIK of 12,500 euro. So that's an extra 300 euro per month for somebody that has a car that is in band D. And it will actually even be changing for electric vehicles as well. So the situation with electric vehicles is that if the original market value does not exceed 50,000, the value is actually reduced to zero, so it gives no BIK. If it's over 50,000, the existing rates based on business mileage are used, which range from 6 to 30%. Now, from next year, the threshold is actually going to be tapered down, which means that much more cars are now going to be subject to BIK, even if they are electric cars. So these are the rates that will be applying next year. You'll have various vehicle categories here, which will be based on the amount of CO2 emissions and then the amount of mileage that they do. So if you take like an Audi A6, for example, which I believe is a category D car, and let's say you're doing somewhere between 39 to 52,000 kilometers a year, you will be paying 20% of the original market value of that in BIK. So I think, everybody that has a company car should probably be really considering if they need it. It is going to cost people quite a lot more than it ever has. You'll notice that if you're only doing a very small amount of mileage, you're actually kind of penalized for it. So, given that a lot of people are working from the office or working from home a lot more now, and they might not be on the road, you need to consider if it's worth having a company car. Maybe it's more tax favorable for you to get a car allowance rather than a company car. And if you're left with no other choice than to get a company car, I would suggest to look at vehicles that are smaller and have much lower rates of CO2 emissions, or you're going to be paying quite a lot in BIK. So that's everything from our side. One thing I wanted to mention just before we move on, that I mentioned from the start, is all our webinar attendees get an exclusive discount on booking a full financial planning review with us, where we will look at everything we discussed today, make sure that you're getting the best options for your money, and put a plan in place to give you a better future. The normal cost of that is 199 euro, and we have reduced that to just 99 euro for anyone who is on the webinar. So we'll review your current financial situation and plans. We'll talk about setting financial goals and objectives, such as clearing your mortgage, planning for education, and retiring earlier. We'll then map out a cash flow model to project your future financial situation. We'll map out a financial plan on how you can achieve your financial objectives, and we'll identify ways to save you money, reduce your tax, and make your money work harder for you. This is just a summary of some of the other areas that we can deal with under that financial planning review. So things like mortgage advice, protection reviews, pension and retirement planning advice, succession planning and estate planning and tax planning, saving for kids' education, and tax-backed schemes such as the EIS scheme. You can check out our website to get more information on that, or even any of the webinar videos that we do. And our online budget calculator tool is on our website that I mentioned earlier, and you do have the chance to win a full free financial review by completing that. You'll also find us on the usual social media channels like Twitter, Facebook, and Instagram. So just want to thank everybody for their time. I hope you got some benefit from that. My own contact details are there if anybody wants to reach out to me directly, and we can open it up to a quick Q&A session now. I know there was a lot of questions sent in, and we have got some in the Q&A box as well. So Cliona, if you want to maybe run through some of the questions that came in prior to the webinar.
Perfect. Thanks, David. I'll start just with one or two that have come in through the Q&A function. So if you have already made a one-off ABC payment in 2022, can I do another one-off payment after the 31st of October for this tax year?
So what you need to do there is calculate what your scope is to contribute to your pension each year, based on the table I showed earlier. So for instance, I can put 20% of my earnings to a pension each year. So what I need to do is find out how much actually went into a pension last year, this year, and then see if I have any scope within the 2 years. If you made a contribution that you already have allocated to this year or intend to, you need to see if you have any more scope left. And if you have, you can make another contribution. If not, you can see if you can backdate some to last year. So basically, if you make a contribution to your pension, saying today, you actually have an option whether to backdate it to last year or offset it against this year, or do a combination of both. And yes, as soon as we go into next year, you can then do a contribution relative to 2023's earnings or backdating to 2022. So look, I hope that answers it.
Thanks, David. This person has said they have a pension from a previous employment, and would you have any suggestions on what they should do with it? Should they leave it, or how should they proceed with it?
Yeah, good question. Firstly, it depends on the type of pension. If if it's a defined benefit pension, worthwhile getting some advice around it. But generally, the rule is to maybe leave that where it is. But we need to find out more on it. Now, if it's a defined contribution scheme, which I assume it is, because most people will have a defined contribution scheme nowadays, your option is to leave it where it is in the old company scheme, which I'm not really a fan of, because there's kind of a, it can be, you can lose a lot of options. There's kind of a lack of control or management, and it's quite restrictive because you're kind of bound to only what that old scheme provides. Or else you can move it into your new company scheme, or else move it into something called a personal retirement bond. Now, I'm kind of against moving it into your new company scheme as well, okay, because people are always about amalgamating their pensions, but it can actually be quite advantageous to have a couple of different pension pots, because you can retire them at different points in time. So if you move your old company scheme into your new company scheme, all of those funds are going to be locked up in that scheme until you either retire or leave the company. So what's usually the most favorable option for a lot of people is to move the funds to something called a personal retirement bond, which basically just moves them into a pension in your own name. You can pick any provider or fund in the market you want, so you can make sure you're seeking out the best options. It's a separate pot to your new scheme, and with that, you get the ability to access it from age 50 onwards. So it does give you earlier access than a company pension as well, and just gives you a bit more management and control. So that's usually the preferred option for a lot of people, but we need to have a look into things in a bit more detail. So I'd maybe recommend, if that person wants to give us a shout, and we can have a look and advise you on your options.
Great, thanks.